Today, we will talk about top 5 passive income investments that actually work. In the world of investing, one of the most sought-after goals is achieving passive income. Passive income is money you earn with little to no active involvement, allowing you to generate a steady stream of income while you focus on other priorities in life. The concept of earning money while you sleep is appealing, but it requires a smart approach to investing. If you're looking for reliable passive income options, here are the top 5 passive income investments that actually work. 1. Dividend stocks. Dividend stocks are among the most popular passive income investments. These are shares in companies that pay you a portion of their profits regularly in the form of dividends. The dividends are typically paid quarterly or annually, and the amount can vary based on the company's performance and policies. Investing in dividend stocks allows you to earn a steady stream of income while potentially benefiting from stock price appreciation. The best part is that many well-established companies pay dividends consistently, making this a reliable source of passive income. For example, companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola have a long history of paying dividends to their shareholders. There are 2 main ways to benefit from dividend stocks. First, by collecting the dividends as cash payments, or second, by reinvesting the dividends to buy more shares of stock, which can compound your returns over time. To maximize your success with dividend stocks, focus on companies with a strong track record of dividend payments and stable growth. A diversified portfolio of dividend-paying stocks across various sectors can also help mitigate risk. 2. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are an excellent way to invest in real estate without the hassle of managing physical properties. A REIT is a company that owns, operates, or finances income-producing real estate, such as apartments, office buildings, shopping centers, and healthcare facilities. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them a highly attractive option for passive income. They allow investors to benefit from real estate income without the need to directly own or manage properties. One of the biggest advantages of REITs is that they provide access to diversified real estate portfolios. Instead of investing in a single property, you're investing in a pool of properties, which can reduce risk. Additionally, you don't have to worry about property maintenance or tenant issues. You can invest in REITs through brokerage accounts, and they typically trade on major stock exchanges, making them easy to buy and sell. Some popular REITs include Vanguard Real Estate ETF, VNQ, and Realty Income Corporation, O, both known for their consistent dividend payments. 3. Peer-to-peer, P2P lending. Peer-to-peer, P2P lending has gained popularity as an alternative passive income investment. P2P lending platforms like Lending Club and Prosper connect borrowers with individual investors willing to lend money in exchange for interest payments. As a P2P lender, you can earn interest on the money you lend, making it a steady source of passive income. The interest rates you earn can be relatively high, depending on the borrower's creditworthiness, typically ranging from 5% to 30% annually. However, it's important to understand that lending money through P2P platforms involves some level of risk, as there's always the chance that a borrower may default on the loan. To reduce risk, it's a good idea to diversify your lending across multiple loans and borrowers. Many P2P platforms also allow you to set up automated investing, which means your funds will be automatically lent out to borrowers, saving you time and effort. While the returns can be attractive, make sure you understand the risks involved and only invest money that you can afford to lose. 4. Index funds and ETFs, exchange-traded funds. Investing in index funds and exchange-traded funds, ETFs, is a tried-and-true method for generating passive income. These funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. The primary benefit of index funds and ETFs is that they allow you to invest in a broad range of assets, which helps minimize risk while still providing exposure to growth opportunities. Some index funds and ETFs focus on income-generating assets, such as dividend-paying stocks, which can provide a consistent stream of passive income. For example, ETFs like the Vanguard Dividend Appreciation ETF, VIG, focus on companies with a strong history of increasing dividends. Similarly, bond ETFs, such as the iShares iBoxx Dollar Investment Grade Corporate Bond ETF, LQD, provide income through bond yields. Because they are passively managed, index funds and ETFs generally have lower fees compared to actively managed mutual funds. This makes them an efficient investment choice for long-term passive income generation. Additionally, they offer the benefit of liquidity, as you can buy and sell shares on the stock market with ease. Investing in index funds and ETFs is an excellent option for those who want a hands-off approach to investing, while benefiting from market growth and income generation. 5. High-yield savings accounts and certificates of deposit, CDs. While they may not offer the high returns seen in more aggressive investments, high-yield savings accounts and certificates of deposit, CDs, can be a reliable source of passive income for conservative investors. These investments are low risk and offer predictable returns. A high-yield savings account is a type of savings account that offers a higher interest rate than a traditional savings account, allowing you to earn more on your savings. Interest rates on high-yield savings accounts can vary, but they generally offer returns of 1% to 3% annually. While this may not seem like much, it's a safe way to grow your money, especially in a low interest rate environment. Certificates of deposit, CDs, are another low-risk investment option where you deposit money with a bank or credit union for a set period, 6 months, 1 year, or 5 years. In return, the institution pays you a fixed interest rate over the life of the CD. The longer the term, the higher the interest rate typically is. CDs are FDIC insured, making them a safe option for passive income, although you may face penalties for early withdrawals. Both high-yield savings accounts and CDs provide a reliable, though modest, source of passive income, making them a good choice for risk-averse investors or those seeking a more stable option. What do you think of our video? Let me know in the comment section below. Also subscribe to our channel before you go. Thanks for watching.